Hello, welcome back to McCall Invest. Thank you for spending some more time with me here. I went ahead and made another stock here, stock C. I wanted to change around the yields a little bit just so we could kind of see what that does to the math on it and see how that changes the income one could expect to receive through a dividend from a company with a different current yield as well as a different dividend growth rate. So now we're talking about stock C versus stock A. I kept that on the board because we do see a lot of these high yielding stocks. There's a lot of really attractive ones at the moment. So this feels like a very a common yield you can see out in the real stock market right now, right? So I just wanted to keep that there just so we could look at that one, the high yielder versus one with a little bit of a higher dividend compound annual growth rate as well as a higher yield. As you remember in the last video, we had stock B, Bravo, which was a 1% current yield and a 6% dividend compound annual growth rate. So we increased each of these numbers here by one. And we're going to see how that makes a tremendous difference. Now, everything else is the same, though. We still have the starting share price of $100. But you see, I changed here. The starting dividend for A is still the $5, right? 5% of $100. But for C, now we have $2. In the last video, that was $1 for a 1% yield. Now it's $2 for a 2% yield. So very quickly, it's going to be a quick video. I just want to show how we can do that math again, just so everyone can really get this formula down. So we got a $100 share price, let's say, times 1.02. That's 2% of $100, right? So 102. So you minus your original 100, and then you got your $2. So it was $2 that you get for the first year, your initial investment there, $2, like we said. Now we're going at 7%. So let's do that math. So we got a $2 dividend, and then they raise it 7% that first year, 1.07. Boom, 214. Next year they raise it again. Boom. There we go. You can see the numbers on the screen here. Just showing this real quick, guys. Anybody can do this. Don't wait for someone to tell you their, math or what they think or what they analyze. You can do this yourself, just spamming times 1.07 times 1.07 times 1.07. That's another year, 7% more growth. Okay, we're up to $3. Boom. So let's see. I've got the math all written out here for you. So we must have done it 7 times here to be at $3. So we can see how this jumped. I'm just going to really quickly, let's look at this versus A, stock A, first of all. This is your high yielder. So $5.10 after the first year for stock A, versus we're at 207 down here for stock C. 5 years, quite a nice amount of growth actually. But then 10 years, that's really, where you start to see, okay, wow, this thing is really growing. You'd still be behind, of course, versus the high yielder, but this isn't a large amount of time. This is not a lot of time. So let's see now the 15-year, the 20-year, the 25-year, the 30-year, and the 35 and even 40 years so that we can really see what this kind of a dividend compound annual growth rate can do for you. Okay, here it is. This is all the math right here. So we've got, look at these numbers. Boom. From the original $2 after 15 years, now you're pulling in $5.15 from that same one share that you bought for $100. So think about that. Plus you've received those dividends every single year, and you've done whatever you wanted with them. You spent them. This is not factoring in any type of reinvestment of the dividend. So you can see how this thing just grows like wild, even if you're taking that money and buying bubble gum or whatever you wish. Look, we're almost there at 20 years, right? this is kind of an interesting point here where now you're boom after 20 years, now you're getting more income from the low initial yield or with the higher growth rate. That's something to keep in mind. That's something I thought we were going to see a lot earlier, especially in the other example, but we never even saw it at 40 years. But if you look down here at 40 years, we're talking, oh my, that's almost triple the amount of dividends. Um, after 40 years, the high yielder is paying you $11.04, same as last video, per year. Whereas the stock C, this new one with the 2% starting yield and the 7% dividend annual compound growth rate, is paying almost $28. My goodness. That's just tremendous. That is a lot of money. And again, guys, this is not reinvesting any dividends, which would make this number even way bigger, both of them. I think it would do more to this one, obviously, because it has the higher yield. But I just want to show this. Like this is how the math works. This is how it goes nuts. You got to hold stuff for a long time, and it's really amazing. It's amazing what the dividends can do over long periods of time. So I hope you got some value out of this channel, out of this video here. Just getting to see some of the differences here. I'm showing my work. Once again, thank you for spending time with McCall Invest. Some other good channels are the Money Guy, PPC Ian, and of course, we love Dave Ramsey over here. So do your own research and have a good one.